Okay, coming back, come back. Okay, so this is our example expanding after 10 years. Okay, we can start from the 2015, right? Okay, so here this table. Sorry. So where is okay here table? Okay, the table, the 10 years. So it's 2024. Okay, so the table. So this one. Okay, so you have to estimate the 10 years the future cash flows, and one more thing is to estimate the terminal value at the 2024. That is your last year. As I said that, okay. So if okay, I just use the three periods, okay, to be our example. Okay, date one, date two, date three, and the P3 is our the terminal. Okay, terminal value. Okay, how we can use the available information to estimate our P3. So last year we just use the 1 plus G, R minus G, and the D3. Okay, so this one, and also same with this case here, because we have a 10 uh, cash flows. Okay, like you have a 3 years dividends. Okay, so you estimate after 10 years the terminal value. You have used the terminal debt 10. Okay, like here you change the formula by the D10. Okay, here's D3 because we just the estimated D3. Okay, if you estimate at the depth 10, so here D be used by 10. Okay, D10. So the same is the 10 year, right? We can start from the 2015 to 2024, 10 years. So over the time, 2024, you want to get the estimation of the terminal value. So you use the 10. Okay, cash flows the 2024, the last year, and time the 1 plus G over R minus G. Okay, so here, okay, this one 1 plus G times the 2024 abnormal, okay, profits, and minus G, and times the 1 plus G power of T. Okay, so 1 plus G power of T, that is you discounted the future value, the future terminal value. Okay, become to present value. Okay, this one. So about my expansions to the TV AP, any question? Hello.
No, sir. Thank you.
Okay, yeah. Okay, thank you. Okay, this one calculating the terminal value for HMM. Okay, so this one terminal value. So this one by formula. So you have this kind of have this the useful numbers evaluation. Okay. Yeah. So here, so value net operating assets. Addition of the value of the investment assets. Um, and addition present value of test shares and debt, subtract value debt, subtract value of non-controlling interest, uh, equal of equal last elements equity value. Okay, so The primary advantage using asset valuation to estimate equity value is that it is less sensitive to expected changes in leverage and non-operating investments. It is useful to check assumptions used against the time series trends for companies for performance ratios. Stock price public traded companies are good to compare estimate of value. Sensitivity analysis for different economy scenarios are a good idea to conduct. Some practical issues in valuation. In practice, analysts must deal with a number of issues having an important effect on valuation, including accounting distortions, accounting choice, social correcting affects both earnings and the book value. Negative book values of stock firms firms in certain industry sectors, among others, may have negative book equity. Assets, cash flow, balance, and cash flows. Firms with cash beyond the level required to finance operations warrant further investigation and to understand whether the excess cash indicates the government problems. Concluding comments. On this chapter, apply valuation theory discussed in chapter 7 along with the forecast addressed in chapter 6. The HMN example provide insight into challenges posted in the valuation process. Strategy and accounting analysis are critical to arriving at the assumptions that drive the value estimates. Okay, this is our chapter 8. Any question about to my explanations of the chapter 8? If no questions over my explanations, I think I want to continue to explain chapter 9. Okay, the chapter 9, there is the applications of the chapter 2, chapter to the chapter 9. Okay, so it's apply to equity security analysis. Okay, so the chapter 9 provides our with the key concepts. Key concept 1, security analysis. We know is one step in the overall process of the maximizing progress toward an investor's objectives. Step 2, security analysis is conducted by a variety of individuals for different purposes. For most analysts, a key objective is the identification of mispriced stocks. Investors' objectives are highly idiosyncratic and must be matched with the appropriate investment. For example, individuals must consider risk tolerance, tax rate, stage of life, other assets, among other factors. There is a vast array domestic and international debt and equity instruments whereas mutual funds that hold combinations either or both. The efficient market hypothesis posits that security price reflect all available information fully and immediately upon its release. A perfectly efficient market would make it impossible to identify miss the price stock using public information. The low financial statements, if the markets are extremely efficient, the few who receive the newly announced financial information could trade advantageously on it before it is fully disseminated to the rest of market. Much empirical evidence supports the primary security markets having a high degree of efficiency. Some evidence includes market reactions to public announcement are quick. Specific mutual funds or analysts who consistently generate abnormal returns are difficult to identify. Some studies in recent years have re-examined the widespread acceptance of the efficient market hypothesis. Approaches are quite varied as illustrated by the following contrast: active vs passive management. Active management relies heavily on security analysis, while passive management typically seeks to match some benchmark performance through holding a portfolio of the securities. Quantitative vs traditional fundamental analysis. Technical analysis attempts to predict stock price movements based on market indicators. Fundamental analysis attempts to evaluate current market price relative to future projections of earnings or cash flows. Formal vs informal variation. Formal variation of the type described in Chapter 7. However, less formal analysis such as comparing analyst opinions of consensus forecasts have become popular. A process of comprehensive security analysis. A generalized security analysis framework is useful given the variety of approaches may be taken. Selection candidates to analyze speculations by industry sector or potential mispricing basis allow more depth of the analysis. Inferring market expectation. Identifying potentially mispriced securities require comparison of the analysis expectations with those of the market. The tables 9.1 and 9.2 give an example analysis forecast under different scenarios. Okay, so here scenario 1, scenario 2, scenario 3 at different calendar year 2015, 2016, 2017, 2018 after 2018. So implied earnings per share in 2018. Okay, so this one, okay, 116. Okay. So comprehensive security analysis process developing analyst expectations, forecasts of earnings and the cash flows along with an estimate of value must be derived from the analysis performed. The final product security analysis. The final financial analyst must automatically recommend some action to take on a security based on the analysis conducted. Analyst and fund manager performance has been the topic of extensive research. Performance of sales side analysts. Sales side analysts have the incentive to be overly optimistic with their forecasts and recommendations. Recent research indicates these analysts' recommendations outperform market index and the risk benchmark. Research indicates that analysts play an important role in market efficiency. Performance of fund managers, there is no consistent evidence that actively managed mutual funds produce the superior returns for investors. Security analysis is part of a larger process that involves establishing investment objectives, developing expectations about future return and the risk of individual securities, combining individual securities into portfolio that meet investment objectives. A large body of evidence exists supporting a high degree of efficiency in domestic markets, but recent studies have explored the issues. Okay, this is our chapter 9. So next we is our watch video time. Okay, so any question? Okay, no question. Let me find the video.
The most widely used multiple in the world. That's the PE ratio. Everybody knows what the PE ratio is, even people who might be novices in the market. But do they really know what the PE ratio is? As we'll see in this session, there are widely varying definitions of what the price earnings or PE ratio is. Some of those definitions make sense and some don't. And as we will see, when you use a PE ratio, whether you like it or not, you're making all of the assumptions you were making when you did an intrinsic valuation. You're making assumptions about growth, assumptions about cash flows, assumptions about risk. The only difference is those assumptions are implicit rather than explicit, and that sometimes can get you into trouble. The last session, I laid out a 4-step process for deconstructing multiples, and I thought I'd try the process out in the most widely used multiple in the world, which of course is the price earnings ratio, the PE ratio. So here's what I'm going to do. I'm going to define PE ratios, describe them, analyze them, and see if I can apply them. And the rubric we have for PE ratios can be extended to any other multiple. So let's start the process. As I mentioned in the last session, the PE ratio is internally consistent. The numerator is an equity value, and the denominator is an equity value as well. In fact, it's the one multiple that most investors think they know how it's computed. But do they? In fact, take a look at the PE ratio. The numerator is usually the current price. That's usually a consensus, though sometimes you see an average price, a moving average price used, but it's usually the current price. It's in the denominator that you get the real action. And here are the choices. You can divide by earnings per share in the most recent fiscal year. That's called current PE. You can divide by earnings per share in the last 4 quarters. That's called trailing PE. You can divide by earnings per share expected over the next 4 quarters. That's forward PE. Or you can divide by earnings per share in the year 2022, which is really, really forward PE. Why would you do that? Desperation drives you to do strange things. If you're an equity research analyst tracking biotech companies and they're all losing money, here's what you do. You estimate the expected earnings way out in the future, and when it turns positive, you divide the price today by that earnings, and you turn around and say, that stock is cheap. It's trading at 6 times 2022 earnings. You can divide by earnings per share before extraordinary items or after extraordinary items. Partially diluted, fully diluted primary earnings per share before option expensing, after option expensing. What I'm trying to say is you take any company, you could probably write 15, 20, 25 different numbers, all claiming to be PE ratios at any point in time. What should you take away from it? The next time you sit across a table from somebody and start talking about PE ratios, before you start talking about the numbers, make sure you're talking about the same thing. Each of you should put down your definition of PE ratio on the table and see if it matches up before you get too involved. So definitionally, price earnings ratios pass the test. Just make sure that it's defined in exactly the same way for the two people involved in the discussion. Second step in the process, and I said this was a statistical process. Here's what I do at the start of every year. I take every company for which I can find a market price. Every company. I don't select the companies that I like. I just pick every company. And for every company, I try to compute a price earnings ratio. You're saying, why try? You're going to see in a minute that not every company will have a PE ratio available for it. I compute these PE ratios by companies, and then I draw a histogram. I don't know how much you remember your Stat 101 class, but a histogram is not sophisticated. You just count the number of companies with PE ratios between 0 and 4, 4 and 8, 8 and 12, and so on, and you put in a distribution. So here's my distribution of PE ratios at the start of 2013, but it's pretty much looked like this every year that I've done it for the 20 plus years that I've been doing this distribution. The peak is to the left, the tail is to the right. It's not a symmetric distribution. The lowest value of PE ratio you can take is 0. The highest value, who knows? In fact, here are the implications because the distribution is asymmetric. I computed the standard statistics for this distribution. I started with the two numbers we always do with any distribution, the average and the standard deviation. And the average number for current PE for US stocks is staggering. It's over 80. But before that scares you too much, keep going down the table and you'll see a median value for the PE ratio. Notice it's about 16.5. That is a much more meaningful number to focus on if you're looking at PE ratios. In fact, in general, when you use multiples, avoid the use of averages. Those averages are going to be skewed by the fact that the outliers all lie in one direction. It makes far more sense to talk about medians and averages when you talk about multiples in general. Notice also that out of the 7,000 plus firms, only about 3,000 plus firms have PE ratios for them. What happened to the rest? Well, there's a simple explanation. For a company to have a PE ratio, the earnings per share has to be positive. So for those companies where the earnings per share are negative, they drop out of the sample. So what? It matters because you create bias in your sample by the companies you eliminate as much as the companies you leave in. The companies that you eliminate because they have negative earnings will tend to be younger, riskier companies. And that's a danger whenever you take statistics of a subsample that is not an unbiased sample. In fact, as you go from current PE to trailing PE to forward PE, you lose more companies. You know why? To get a forward PE, I need expected earnings per share in the next 4 quarters. And the only companies for which I have that available are companies that are tracked by analysts. So any company that is not tracked by analysts, I lose from my sample. We introduce bias in the most subtle ways based upon the multiples we pick. So next time you pick a multiple to do a valuation, think as much about the companies you will lose by using that multiple as much as the companies that will stay in your sample. Now here's a third and final characteristic I want to list about these multiples. Not only are they asymmetric, not only does it throw off the median and the mean and the difference between those two numbers. You look across the world, it's amazing how much market share in common. Again, at the start of every year, here's what I do. I take every publicly traded company listed globally for which I can get a PE ratio, And then I put the distributions on top of each other so I can compare the distributions. I break them down into subgroups. I have US companies, European companies, emerging market companies, Japanese companies, and Australia, New Zealand, and Canada form their own subgroup. Look across the subgroups. Across the subgroups, you see the same kind of distribution. Peak to the left, tail to the right. The median values do vary across the subgroups, but not in a way that might be predictable or easy to explain away. It is true that the US had the highest median PE in 2013. It's true that Japan had the lowest median PE. But it's also true that emerging markets had a higher median PE than European markets do. Strange if you think about it, and if you think about emerging markets as riskier than European stocks, but it shows you how the line between developed and emerging markets is blurred, especially over the last 4 or 5 years. So if you look at the distribution, keep in mind the asymmetric nature of the distribution, how it throws off your statistics, and how much more companies share in common globally than they have as differences. So now that we've defined and described PE ratio, let's move to the analysis. As I said, analyzing a multiple is not difficult to do if you remember that very simple rubric I gave you in the last session. I said if you have an equity multiple, which is what the PE ratio is, go back to an equity valuation model, and the simplest one you can think of. The simplest one I can think of is a stable growth dividend discount model. It's the Gordon growth model. If you divide both sides of that equation by the earnings per share, you have an equation that tells you what the PE ratio for a stable growth dividend paying company should be. And it tells you the variables that should drive that PE ratio. And guess what? There are 3 variables that drive the PE ratio for a stable growth dividend paying company. The first is the payout ratio, the percentage of earnings you pay out as dividends. The second is the cost of equity, reflective of the risk of the stock. And the third is the expected growth rate. PE ratios are determined by payout ratios, cost of equity, and expected growth rate. Now, some people are concerned when you see a dividend discount model because we know that most companies don't pay out what they can afford to in dividends. If you feel uncomfortable about using dividends, here's an alternative. Use the potential dividend. We talked about this in earlier sessions. The free cash flow to equity is a measure of what a company can afford to pay out, not what it actually does pay out. Just replace the actual payout ratio with a potential payout ratio, and you got the determinants of the PE ratio for a company. Now, how am I going to use this? As a first step, I'm going to take this equation and back up and look at the variables that drive the PE ratio, and 3 very basic propositions emerge. Proposition 1, other things remaining equal, and you can take a look at the equation to confirm this, the higher my growth rate, the higher my PE ratio. It makes sense, right? Higher growth companies should have higher PE ratios. Other things remaining equal, and this is proposition 2, higher risk companies should have lower PE ratios. You're saying, but most of the high risk companies I know have high PE ratios. Well, most of them also have higher growth as well. But if you hold everything else constant, higher risk should translate into lower PE. And other things remaining equal, the higher the payout ratio, the higher the PE ratio. But remember, if you hold growth constant and you pay a much higher percentage of your earnings as dividends, you're generating a higher return on equity in your investments. So I would actually restate proposition 3 by saying the higher the return on equity for a company, the more efficiently it's delivering growth, and the higher the PE ratio should be for the company. But as I've mentioned, holding other things constant is difficult to do. Companies with higher growth tend to have higher risk and lower payout. The big challenge in investing is to look at that balance. Is the net effect going to be positive or negative? Because that's what's going to determine whether a company is cheap or expensive. Now, here's the other way to think about this. When I think about investing based on a multiple, I'm looking for mismatches. I'm looking for companies that don't fit the standard. What do I mean by that? Most companies that trade at low PE ratios deserve to trade at low PE ratios. They have high risk or low growth or terrible returns on equity. So what I would like in a perfect company, a company that I'd like to add to my portfolio, are the following. I'd like a low PE ratio. I'd like to buy something cheap. I'd like a high growth rate, because a low growth rate would explain away the low PE ratio. I'd like low risk, again, because a high risk would explain away the low PE. And I'd like a high return on equity. I'd like a company with low PE, high growth, low risk, and high return on equity. Now you might say, what chance do you have of finding something like this? Well, it might be difficult, but no harm looking. In fact, if you ever screen for stocks, you take a big universe of stocks and you screen for attractive stocks, this is the framework you should think about for screening. Screen for low price, low price earnings, low price to book, whatever the multiple is, look for companies that have mismatches that essentially should not trade at low PE. In this case, I'm looking for companies with high growth, low risk, and high return on equity. It's an effective way of bringing in relative valuation into your investment process. So now that we've talked about the variables that drive P ratio, let's try it out. Let's take it for a spin. And I'm going to try using P ratio in a couple of sectors to find cheap companies. The first one, I'm going to do what most equity research analysts do, which is do some storytelling. The sector you're looking at is the beverage sector. So basically, I have about 30 companies in the sector. I've listed out the price earnings ratios in the second column. And you know what I'm looking for? I'm looking for low PE ratios, right? Track the table. There are 3 companies in this sector that trade at PE ratios below 10. One is Andre Wine, the second is Todd Hunter, and the third is Hanson Natural. They all traded below 10. That makes them cheap, right? Not so fast. Take a closer look at Andre Wine and Todd Hunter. You see why their PE ratios are so low? It's because they have the lowest growth rates in the sector. Now take a look at Hanson Natural. It looks much more attractive, right? It's got a low PE and a high growth, but here's the catch. It's a really risky company. Now do you see the problem with storytelling? It's going to be a case of on the one hand and on the other hand, at the end, I'm going to ask you to trust my gut. So let me give you a slightly more sophisticated way of controlling for differences. I'm going to go way back in time to 1999 and show you the PE ratios for some telecom ADRs. ADRs are foreign stocks that are listed in the US and trade in dollars. Presumably because they have to follow US GAAP, the earnings you see reported here reflect US accounting standards. So you're comparing apples to apples. I'm going to pick a particular stock in this particular table, Telebras. Telebras in 1999 was the Brazilian telecom company. It looked cheap. It traded at 8.9 times earnings, much lower than the PE ratios for the other companies you see for the most part in that sector. But here are the 2 things that worry me about Telebras. One is, if you look at the column for growth, it has lower growth than many of the other companies in the sector. That's my first concern. The second is, even though these are all foreign ADRs, they range the spectrum. Some are from developed markets, like Denmark. Others are like from emerging markets, like Brazil. And in 1999, Brazil was a truly risky emerging market. So Telebras looks cheap, but it's also going to be riskier than the other stocks, and it has lower growth. As I said, storytelling gets you only so far. So here's what I did. I went back to my Stat 101 book. I went to that chapter on multiple regressions. Like you, when that chapter was taught, I wasn't listening. I said, when am I going to use this? I think I found a use for it. If you remember your multiple regression, here's what you have. You have a dependent variable that you're trying to explain, and you have independent variables that you use to try to explain the dependent variable. My dependent variable here is PE. That's what I'm trying to explain. The 2 things that concern me are growth and risk. So I decided to run a multiple regression of PE ratios for these ADRs against the expected growth rates for these companies and a dummy variable. You're saying, what's a dummy variable? A dummy variable takes on the value 1 or 0. In this case, I set it to 1 if it was an emerging market ADR and 0 if it was a developed market ADR. I ran the regression. Now, when you run a regression, the first 2 things you check are the R squared. That tells you whether your regression is actually explaining something that needs to be explained, whether the dependent variable is being explained by independent variables. In this case, the R squared for this regression, after adjusting for the number of observations, about 63%. That might not look good relative to your stat class regressions, but in finance, that's a pretty good R squared. The second thing you're going to check for are the t-statistics to see if the coefficients you have in the variables are actually significant, statistically significant. Both the variables that I used were statistically significant. The coefficients then can be used to get a predicted PE. So here's what I did. I took the regression, I plugged in the numbers for Telebras into that regression. And when I plugged in the numbers, I got quite a surprise. I got a predicted PE which was well below my 8.9. It was only 8.3. The stock looks cheap, but guess what? It deserves to be cheap. That is the essence of relative valuation. Just because a stock has a low PE doesn't make it cheap. So as you look through this session, think about the 4-step process. Define, you describe, you analyze. That analysis yields the variables you should be controlling for. And once you know the variables, you can use this multiple to compare across companies. But in the last 2 to 3 decades, we've seen a proliferation of other earnings multiples. In this session, I hope to look at some of those earnings multiples. In particular, I want to look at a multiple, enterprise value to EBITDA, that's widely used in acquisition valuation and in equity research. Most analysts who use it often don't know what to control for. And in this session, I hope to emphasize that the variables that drive intrinsic value, cash flows, growth, and risk are embedded in your enterprise value to EBITDA multiple. So at the end of this session, I hope you will be able to tell me what companies look cheap or expensive based on that multiple. The last session we talked about PE ratios. Classic equity earnings multiple, been around a long time, lots of investors love to use it. But in the last few years, especially in the last 20 years or so, you've seen a shift away from equity earnings multiples to what I call enterprise value multiples. Let me explain what I mean. Remember our earlier definition of enterprise value? Enterprise value is market value of equity plus debt minus cash, the value of the operating assets of the company. In an enterprise value multiple, you relate that number to some measure of enterprise earnings or enterprise cash flow. Now, the most logical measure of enterprise cash flow in an intrinsic value world is the free cash flow to the firm, which is after-tax operating income minus net capex minus change in working capital. I'll also tell you that you'll almost never see a multiple of true free cash flow to the firm. In fact, if you see a multiple of enterprise value to free cash flow, I can almost guarantee you that it's not been done right, that people stop somewhere in the middle. In fact, what's more common with enterprise value multiples is to see a multiple of EBIT, operating income, after-tax operating income, or most of all, EBITDA. The enterprise value to EBITDA multiple is perhaps the most widely used multiple in many sectors of equity research. So I thought it makes sense to actually focus in on that multiple because everything I say about that multiple applies to other enterprise value multiples as well. Now, with enterprise value to EBITDA, here's the basic definition that you have to deal with. You could take market value of equity plus market value of debt and divide by EBITDA, but almost nobody uses that. In fact, in practice, what you see is enterprise value is computed as market value of equity plus debt minus cash. As I said, lots of analysts use EV to EBITDA multiples. And when I run into them, I ask them a simple question. Why do you net cash out of the numerator? Why do you use net debt instead of gross debt? And you almost never get the right answer. The answers you get are because cash is liquid, and I could use it to pay off what I spend to buy a company. That's not the right answer. The reason we net cash out of the numerator is because the income from cash is not part of EBITDA. It's for a consistency reason. And in fact, when I open that door, it's a Pandora's box. Because not only should I be netting out cash, I should also be netting out any other assets whose earnings are not part of EBITDA. You know what I'm talking about, right? Remember the cross-holdings discussion we had? If you have minority holdings in other companies, if you want to compute the enterprise value to EBITDA correctly for this company, you have to be netting out the market value of those cross-holdings, not just the book value. If you have a majority holding in a company, you have a different problem. Your market value of equity reflects as 60% of the subsidiary that you might own. Everything else in that equation, the EBITDA, the debt, and the cash, come from consolidated statements where you count it 100%. So what you'll often see analysts doing is adding the minority interest, the 40% that doesn't belong to the numerator. But the problem is minority interest, at least from the balance sheet, is a book value number. You have a mishmash. What I'm trying to tell you is getting consistency with EV to EBITDA is easier on paper than it is in practice. So now that we've defined EV to EBITDA, let's describe it. Before I describe it, I also have to tell you that EV to EBITDA multiples are notorious for rules of thumb. What do I mean by that? You'll see private equity investors, LBO investors tell you that any company that trades at less than 6 times EBITDA is cheap. You have to wonder, where do these numbers come from? In fact, that 6 times EBITDA is a very widely used number for a cheap company. Is 6 times EBITDA cheap? Well, it depends. In 2013, it wouldn't have been a bad measure of cheapness. About 25% of companies globally trade at less than 6 times EBITDA. 25% of 40,000 companies is still 10,000 companies, but at least it's the 25th percentile. But to show you the danger of these rules of thumb, I'm going to go back to 2009. And in 2009, 6 times EBITDA would not have been cheap. Half of all US companies, in fact, half of companies globally traded at less than 6 times EBITDA in 2009. That's not my definition of cheap. What am I asking you to do? If you have a rule of thumb, given that we have the data today, why not make it a flexible rule of thumb? What I mean by that is you have all of the data. Why not make the 20th percentile or the first quartile your measure of what's cheap? The data is there. That'll allow you to adjust what's cheap from year to year based on what the market's done. And it'll give you a more reasonable way of thinking about cheap and expensive rather than using an absolute number across time. So now that we've defined and described EV to EBITDA, let's think about what drives the EV to EBITDA multiple. Remember the little technique we used to get price earnings ratios? We'll do the same thing for EV to EBITDA, but because it's an enterprise value to EBITDA multiple, I'm going to go back to an enterprise valuation model. The value of a firm is the expected free cash flow to the firm divided by the cost of capital minus growth. It's a stable growth free cash flow to the firm model. Free cash flow to the firm itself can be written as a function of EBITDA. So basically, you can write out free cash flow to the firm as EBITDA times 1 minus T. So basically, it's the after-tax EBITDA plus a depreciation tax benefit, depreciation times the tax rate, minus CapEx, minus change in working capital. You're saying, why are you messing things up? Why not leave it as free cash flow to the firm? I'm going to replace the numerator in that firm value equation with the expanded version of free cash flow to the firm. And then I'm going to do my algebra. To do my algebra, I'm going to get the drivers of EV to EBITDA. For a stable growth firm, the EV to EBITDA multiple is a function of the following variables. It's a function of the tax rate. Why does tax rate matter? Because EBITDA is a pre-tax number. The higher your tax rate, the lower the enterprise value is going to be for a company. In fact, think of the limiting case. Assume your tax rate is 100%. You should be paying for this firm if all the income is going to be taxed. So the higher the tax rate, the lower the EV to EBITDA. Second factor to drive the EV to EBITDA is the expected growth rate. Other things remaining equal, the higher the growth rate, the higher the EV to EBITDA. Third factor that drives the EV to EBITDA is your cost of capital. The riskier a firm, the higher its cost of capital, the lower the EV to EBITDA multiple. Final factor that drives the EV to EBITDA is how efficiently are you delivering growth? What kind of reinvestment do you need to sustain that growth? And other things remaining equal, the higher the reinvestment rate, the more the CapEx, the more the change in working capital, the lower the EV to EBITDA multiple. We've got the variables that drive EV to EBITDA. Let's put them to use. I'm going to take a very, very simple company with a 36% tax rate. CapEx is 30% of EBITDA. Depreciation is 20% of EBITDA. It's in stable growth and has no working capital requirements. Its cost of capital is 10%. Let's plug the numbers in. This is a stable growth company. I can plug the numbers directly into that equation we saw on the previous page. And if I do, the intrinsic EV to EBITDA for this company is 8.24. You see, what do you mean intrinsic? This is what I would get if I used a discounted cash flow model to value this company. This company should trade at 8.25 times EBITDA given its characteristics. And you're saying, so what? What's interesting about this hypothetical example is I can hold everything else constant in my spreadsheet and change one variable at a time. And that's exactly what I tried. I changed just the tax rate. And guess what? As my tax rate goes from 0% to 50%, my EV to EBITDA goes from more than 16 times EBITDA to less than 7 times EBITDA. My EV to EBITDA is very much a function of my tax rate. Keep that in mind. When you're comparing Irish Telecom to Deutsche Telekom, Irish Telecom has a 12% tax rate, Deutsche Telekom has a 30% tax rate. If you're not careful, Deutsche Telekom is always going to look cheap to you just based on an EV to EBITDA. It's a control for tax rates. Second, I kept everything else constant and changed the return on capital. Holding all else constant, the higher the return on capital, the higher the EV to EBITDA multiple. Companies that deliver high returns on capital should trade at much higher multiples of EBITDA. In fact, if you consolidate the return on capital and cost of capital into one measure, companies that deliver higher excess returns, earn over and above their cost of capital, should trade at much higher multiples of EBITDA. So try this out. Set up a simple company in an Excel spreadsheet. Try changing the numbers. Get a sense of how, as the variables change, the EV to EBITDA multiple changes. And here's how you should use it. Let's assume I'm trying to sell you a company based on EV to EBITDA. I call you and say, hey, this company looks cheap. Its EV to EBITDA is 6. Have your questions lined up. What's your tax rate? What kind of return on capital do you deliver? How much do you reinvest? What's your growth rate? What's your cost of capital? By the time you have the answers to all of those questions, most companies that are offered to you as cheap companies drop off the list. Again, what you're looking for is a mismatch. As with PE ratios, look for a mismatch of low EV to EBITDA with none of the variables that should cause a low EV to EBITDA. So in summary, enterprise value multiples are no different from price earnings ratios, but the variables you focus on will change subtly. Rather than look at equity variables, cost of equity, return on equity, growth in equity earnings, you're going to be focusing on firm variables, return on capital, cost of capital, growth in operating income. And while the equation we used was a stable growth model, the variables will stay the same if you have a high growth company. That's one of the great things about that very simple way of backing out the variables. So let's try one final example to kind of bring home what we just said. Okay? We have a table here, very difficult to read table because the font's really small, but it's a table of trucking companies, basically of their EV to EBITDA multiples. I want to focus on one company on that list that looks very interesting, Ryder Systems. Now, if you live in the US or you've been to the US, you know Ryder System rents out trucks for people to move themselves. It's been around a long time, and it looks really cheap. It's trading at 2.91 times EBITDA. In fact, I pulled this off an equity research report that suggested that this was the reason you should buy Ryder Systems. But here's why you should be cautious. Trucking companies invest in a strange way. They don't reinvest for years at an end, then they replace their entire fleet. You know why Ryder Systems look cheap? It had the oldest fleet in this sector. So you'd have thought it was a cheap company, bought the stock at 2.91 times EBITDA, and 2 weeks later, you'd have woken up to a very harsh reality, which is Ryder Systems would have to issue a lot of debt to fund the next expansion or the next replacement of its fleet. So with infrastructure companies in particular, where you see EV to EBITDA is used a lot, be very careful about both the timing of reinvestment and second, the age of the assets that you're looking at. So in summary, EV to EBITDA multiples are simple to explain if you go back to basics, and you should always go back to basics.
Okay, hello.
Hello, sir.
Hi, any question?
No, sir. Thank you.
No, okay.
Thank you, sir.
Okay.
So far in these sessions, we've talked about valuing primarily
Sorry.
public companies, whether it's this.
Let me check. Okay, so no questions. I think it's the time to say goodbye. It's okay.
Okay, sir.
Okay, and I will. Okay, so I will
Okay.
open. Okay. Thank you. I will open the class in another date. Maybe it's not on the Wednesday. Maybe on the Tuesday or Thursday. Yes, or Friday. Just I take that if you are free over there, so you can come to the the online class. If you are not free, that's okay. Okay. Hello.
Okay, Professor. Okay, sir.
Okay. So no question. I think actually it's time to say goodbye, right? Okay. Thank you. Bye bye.
Bye-bye. Thank you, sir. Thank you, Professor.
Bye bye. Thank you, Professor.